Greetings, empowered investors. We've got a lot to talk about today. There is so much going on in the market, and most of it is pretty darn good news. But good news for one party is bad news for another. Bad news for one is good news for another many times. Now, not always. Of course, there are times when the economic pie expands, and that's the goal of capitalism, and everybody wins. The rising tide floats all the ships. So, it's mixed, right? It happens both ways, of course. So this Wall Street Journal article, if you're watching on video, this was just last week in the Wall Street Journal. It says home buyers start to come off the sidelines, even as rates and prices stay stuck. A new baby, a new job, and other big events spur some to quit waiting. Quote, "You can't pause your life for what rates are going to do," unquote. And that is so true. I have said this so many times. I have shared it on this show for many, many years. And this is where all of the economists and all of the doomers and all of the numbers geeks always get it wrong. What do they get wrong? Well, if you're just looking at the data and you're just looking at the numbers, that will give you one conclusion. But it doesn't give you the data that people capitulate. I've said this for a very long time. People just learn to accept less. They adjust their expectations to the realities of the market. Now, this doesn't happen instantly. It takes some time. People have to work through this mental process, and they have to come to grips with the current state of the market. Of course, several years ago, when we saw rates go up, where prices were already very high, everybody said, no, I can't buy anything. It's too expensive, and I'm just not going to do anything. So demand was destroyed. And all of the home sellers, this is one of the reasons the experts got it wrong, all of the home sellers, well, not home sellers, correction, home owners, they were the ones controlling the inventory. And they said, our deal is so good, we're not selling. And the buyer said, we're not buying. So buying volume went down by almost 30%. It depends where you look. It's varied in many markets. But, let's call it 30%, 25%, right? And so sales volume went way down, but the prices kept going up. And people eventually, after some time, started to adjust their expectations. And they just took what they could get. And how many people did that? Well, 4 million people a year did that, about 12 million people total. I mean, there's 140 million homes in the country. There's 340 million people in the country. And 12 million of these people said, we're buying anyway. We can't get what we used to get. We've come to grips. We've come to terms with the market. We are going to be realistic about what we can do and what we can't do. Nobody in the past, 20 years could get the home that their parents got in 1960, right? Everybody along the way in all those decades adjusted their thinking. They capitulated and they took what the market would provide for them based on what they could afford, based on their budget. And that's the way it is. People capitulate. They just eventually come to grips with reality and they make decisions and they move on. Hey, it's not what we want, but it's good enough. We're having a kid. We're downsizing, we're upsizing, we've got life events, we've got to move for a new job, whatever it is, they come to terms, they come to grips with reality. And that's the way it is. Okay, so we're going to talk about that and a few other things today. But first, I do have an announcement. Now, we are almost 2,300 episodes in for this podcast. And as many of you know, I have many other podcasts as well. So I've got about 9,000 episodes out there total that I've produced in the last 21 years. I've been doing this a while. I was an early adopter. And, back when I used to talk about my podcast, I would have to explain to people over and over till I was blue in the face, what is a podcast, right? And you know what? Nobody even knew about YouTube when I started podcasting. Barely. So we are going to reduce our production schedule just a little bit. Most shows release one episode per week, and we've been doing two per week. And back during the pandemic, We were doing everyday episodes because the news was breaking so fast that I felt I had to talk to you every single day. There was so much chaos and so much turmoil. And if you go back and listen to those old episodes, we were producing one a day. I mean, every single day we were doing an episode just to keep up with the crazy, crazy news cycle. But the news cycle, it's not really that busy nowadays. So I think we can go back to producing a new show every Wednesday. And every Friday, we will, of course, have Flashback Friday. And remember, folks, I used to be better at this than I am today. Yes, I will even say that because when I was younger, 20 years ago, I think my thinking was a little better and a little clearer. Do any of you notice that? It's not exciting, and it's not exciting to admit that, but I really do think that. Now, I'm much more wise than I used to be. But can I think as fast? Nope, I don't think so. I really do notice a difference in the processing speed. But hey, soon Elon Musk is going to be able to upgrade my chip and all of your chips too. But I don't know if I want that chip in my head. But it's coming. We'll have the option with Neuralink. Anyway, look for our episodes every Wednesday and Friday. And occasionally, when a lot's happening, we'll throw out a Monday episode or a bonus episode that week when there's something in particular going on, or and it may not be going on in the world. It may just be going on in my mind, and it's something I want to share with you. But the regular schedule will be every Wednesday and every Friday. And then on YouTube, we produce those videos a day later. So look for that and stay tuned. All right, so let's look at some different metros. Remember, I talked about people capitulating when they buy a house, right? Well, here is an example. So I am showing a map on the screen of the metros with the highest share of mortgage holders under age 30. And here are the cities: San Antonio, Oklahoma City, Nashville, Louisville, or if you're from there, you're probably saying I'm not pronouncing it right. I got to put marbles in my mouth and say Louisville. Cincinnati, Indianapolis, Pittsburgh, Virginia Beach, Buffalo, and Hartford. When I was in my 20s, I remember people in their 20s. In fact, many of them were my clients. Two actually ended up as my girlfriend. No, three. I forgot Lynn. She was 26. They ended up as my girlfriends. Okay. And they were buying properties in beautiful Orange County. Okay. They were buying properties in tier 1 cities, super desirable markets. But what did all the people in their 20s do? They capitulated, just like I just said. They adjusted their expectations and they said, look, we can't afford a home in New York City, LA, San Francisco, Seattle, Orange County, San Diego, right? We can't afford that. And when I say Orange County, I mean Southern California, Orange County, the expensive market where I'm from, and where we just had Empowered Investor Live. By the way, just a tangent here. Thank you to all of you who came to Empowered Investor Live. It was so fun. And I got to tell you, I am not schmoozing you when I say this. I love all of you. I love our clients. You're just the greatest people. So it was just awesome to see all of you live at Empowered Investor Live in Irvine. So we got to keep doing live events because they're just so much fun, but they are so much work. It is so much work to do a live event, and it's so much money. Oh my God, they're just getting so expensive. It's crazy. But anyway, you look at these cities where people under 30 are buying homes, right? Where they've got the highest share. And it is not these tier 1 cities anymore. I mean, Buffalo, New York is definitely not a tier 1 city, okay? I don't think anyone's growing up in Los Angeles or in San Diego saying, I'm 13 years old and my goal is when I'm in my late 20s, I want to buy a home in Buffalo. Just saying. Now, sorry, Buffaloians, because guess what? That's where my family's from, upstate New York, between Buffalo and Rochester. And as a young kid, I don't really remember much about it, but I used to live in Rochester, actually. So Buffalo, Rochester, I know that area, okay? Anyway, this is the point of capitulation. This shows you that people adjust their expectations because they can't afford a home in LA or Miami or New York or Seattle or San Francisco or any of these places, but they used to be able to afford that. They used to be able to afford these tier one areas. This is what inflation does. It destroys the standard of living. But oddly, the standard of living, actually, even though it's less expensive, may be better in some of these places. I mean, we don't have to talk about what's happened to many cities in California with Gavin Newsom's ruining them, with a homeless population, with a crime, it's just out of control. But that's another topic. Okay, remember, the one thing you absolutely positively must have if you want to have a real estate crash is you must have tens of millions of homeowners that are in dire straits, that are in desperate circumstances, that need to sell their home. And we have the exact opposite of it. Those tens of millions of people need to turn into millions of people that actually put their home on the market and are willing to accept any price they can get. And we have the exact opposite of that, as I've been talking about for several years now. We have tens of millions of people who are extremely comfortable, that have cheap mortgages, that don't want to sell, that don't want to move, that aren't giving up their homes because their home is too good a deal, right? That's what we have. Look at this article. This is from Mike Simonson, who's been on the show many times before. In fact, I just had dinner with him a week and a half ago in San Francisco when I was up there. Mortgages may be the sunny spot in a cloudy U.S. economy. New FHFA data shows that, did I say FHFA? I think, yes, I did. Remember, the brain ain't what it used to be always, right? New data shows that the current mortgage borrowers are in a strong position to weather an economic downturn. And they are. Remember that study I did a couple of years ago when I was saying to all of the crash bros and all of the doomers that they were wrong? And they were wrong because look what happened. Where's the crash they all been predicting, right? Just didn't happen. So all of these doomers told me that I was wrong and that there would be a real estate crash because massive unemployment was coming. Well, that didn't happen. They were wrong about that. Now, hey, the jobs picture ain't quite as good as it was. And I know it's manipulated, but it's always been manipulated. Okay, so compared to what, right? If they manipulated it in 1980, in 1990, in 2000, 2010, and 2020, they're still manipulating it. Okay, it's just the manipulated data compared to the manipulated data. It's okay. All right. Now, with the CPI, otherwise known as the CP lie that manipulates the inflation data, we've talked about that many times. With the CP lie, that manipulation actually did significantly change right around 1980. Talked about that in past episodes, won't go into it now. But what I proved with my little study I did is that all of these people that own the 140 million homes in the US could afford the home they had and the mortgage they had based on unemployment income. Government-sponsored unemployment insurance, they would literally qualify for the mortgage they have today because their mortgage is so cheap that they wouldn't have to sell. They would not be in distress. Remember, the one thing you must have is tens of millions of distressed homeowners become millions, now not all of them turn into sellers, right? Who become millions of distressed home sellers. We have the complete opposite of that. Have you ever wondered how the top real estate investors consistently find the best deals before anybody else? Well, listen up because this can transform how you invest. I'm excited to share something that's revolutionizing the real estate game. It's called Connected Investors. This is a really cool platform that gives you access to all of the property records nationwide. Truly amazing. It's not just a platform though, it's a secret weapon. It does a whole bunch of things besides the property data. It's a social network as well. It's built by successful real estate investors for real estate investors. Find off-market deals instantly, access accurate ownership contact info, make smart data-driven decisions, and secure funding for your deals from a vast network of private and hard money lenders. Whether you're a beginner or a pro, Connected Investors is your go-to tool for smarter, faster, and more efficient investing. Try a 7-day free trial at jasonhartman.com/connected. Again, that's jasonhartman.com/connected. And let us know how much you love this software. Okay, here is the loan to value ratio for US mortgages. It's only 47%. That is the average loan to value ratio of outstanding mortgages. Back in 2013, the average mortgage was over 70% LTV. And it has steadily gone down, down, down. It leveled off during the pandemic boom, and it's gone down even further since then to only 47%. This is the equity cushion people have that means the market, if it did crash, which I don't know how it's going to crash based on all this data I'm giving you, but if it did, say the market went down 20%, people would still have 27% equity in their homes. I mean, it's just a non-starter to be a crash bro, to be a doomer. It just didn't happen, and the data is still supporting a strong but slow market, okay? And probably a little slower than before. Now we'll see, the Trump administration is a wild card. I told you that this year was the hardest year to predict of my entire career, what's going to happen, because we have a very, very disruptive administration running things right now, and it is a lot of question marks. But look, go back to the fundamentals, right? The great American cash cushion, 82% of borrowers have at least 30% equity in their home. And I'm showing a chart on the screen. If you're listening on audio only, I'm showing a chart that just shows each tranche of equity. Virtually nobody has negative equity, okay? Everybody has positive equity, the worst being in the 20% equity range, and then going on down from there into, well, when I say down, I mean more and more equity, meaning the average is 47% LTV. That means 53% equity. Oh, by the way, when I told you that number before, I did that backwards. The loan against their property is 47%. That means they have 53% equity. So if the market went down by 20%, they would still have 33% equity, not 27%. I was mistaken there a minute ago. It's better than I thought by 5%. Okay. So it's pretty darn amazing, the dynamics of the real estate market. Here's the outstanding mortgages by interest rate. And you can see that people have very, very low rate, very comfortable mortgages. However, there is something interesting about this. Remember those 4 million people a year for the last 3 years that have been buying houses? Well, they have higher interest rates. And so interestingly, and if you're looking at the chart with me, I got to try to always explain things for audio only listeners because, well, that's most of our listeners. And I love you. Keep listening on audio only. I love the portable format. It's great. But if you have a chance, grab these YouTube videos and just so you can see the charts. So here you see the pandemic era, right? And during the COVID era, we had very few mortgages that were 6% or above. But that number has actually increased to now where we have about 20% of the mortgages that are 6% or higher. So that's interesting. Why did that happen? Well, because 12 million people bought a house since the rates went up, give or take. It's not an exact number, back of the napkin math, okay? But that is actually, interestingly, a positive sign because those people were underwritten in more harsh circumstances than the low rate people were underwritten. The low rate people, they only had to qualify for a very low payment. So you see how that works? Okay, interesting to note. I just want to encourage everybody to try things and to do more things. And I saw this Babe Ruth quote, and I thought it was great. Every strike brings me closer to the next home run. And that's how life is. It's number one, on-the-job training. We got to just go out, take risk, make things happen, and just understand that every time we fail, as long as we're failing forward, we are getting closer to the success we seek. I remember when I was a traditional realtor, a very young one, I remember listening to a sales trainer by the name of Jerry Bresser. He was a good sales trainer, very old school guy. I had his cassette tapes. And he would talk about how you should stack $25 bills on your desk, right? And every time you make a cold call and someone hangs up on you or, rejects you in some way, move it to another pile. Have these two piles of the $5, right? Because you got closer and closer to success the more you failed along the way. And that's the way it is with everything in life, right? We got to just keep trying. We got to be optimistic, and we've got to just keep doing things and keep moving forward. The only people who ever really lose are the people who don't move forward, the people who don't try, who don't, just take the risk to get into things. And you'll never figure everything out before you start. That's just not the way life works. And people, I sometimes see them, they think about, should I invest in real estate or, not? I don't know. I don't know everything. What if this happens? What if that happens? Yeah, it's probably going to happen. Okay, all the this and the that are going to happen to you eventually if you do enough things. But you got to just take more swings, right? And that's the way you get success. I've told you my story before, but I bought my first rental property when I was 20 years old. I lived at home. Okay, I did not have a place of my own, but I owned a rental property. And in this first rental property, I put a tenant in there, and it was going well for a while, and then the tenant just stopped paying. I would go knock on the door, and I would try to collect the rent, and I was a kid, right? And they didn't respect me at all. And so they just stopped paying the rent, and I had to evict these people. And that was my first experience. Do you think I would have had every reason to just give up and say, hey, this real estate thing doesn't work? Nobody would have blamed me. They would have just said, I get it, Nobody looking around, none of my friends would have blamed me for just giving up. But I'm sure glad I didn't, because I made many, many millions and millions of dollars since then. And that's why you got to keep going, even in the face of discouragement. Okay, let's just look at this real quickly. In the conversation about Trump tariffs and the Hartman Risk Evaluator, which I've been teaching for 21 years, which is based on the very reliable price of construction materials that, they have intrinsic value. They're not attached to any one currency. Every human needs them because they all need shelter, and they are traded globally, right? So we look at those materials, and I always talk about being a packaged commodities investor, investing for the commodity value almost as much as for the real estate value. And with that thinking, this is an interesting visual that I got that shows the breakdown, okay? So the average total construction cost is $428,000. The finished lot cost in this average example, $91,000, including the financing cost. So keep in mind, the builder didn't pay that for the lot, but they had to carry that lot for probably 2 to 3 years, and they had to finish all of the utilities to bring them up to the curb, right? So that represented, in this case, 13%. I'm just going to round off for speed here, 13%. Financing cost, another $10,000, 1.5%. And that doesn't include the financing cost of the lot, because that's separate, because it takes much longer to finance the lot, to get it entitled, to do construction, all of that kind of stuff, right? Overhead and general expenses, $38,000 or 5.7%. Marketing, $5,600 or 0.8%. Sales commission, $19,000 or 2.8%. Profit, $73,000 or 11%. Now that's in a very good market. Builders don't always get that kind of profit, okay? But think about the impact of this house that is sold for $665,000, okay? Remember, $428,000 was the builder's construction cost. That's not the sales price, okay? It's sold for $665,000. It's 2,600 square feet is the average square footage. And you've got the whole breakdown. And think of the impact of tariffs and increasing labor costs. By the way, you know what? They just baked the labor cost into all of these numbers, I guess, because there's no line item for labor cost, okay? And imagine 13 to 20% of these laborers being deported because they're here illegally, and that's about the estimate. And imagine the cost of these inputs increasing, right? What does that do to the price of housing? Even the price of resale housing goes up because all of those new houses sell for more. The pull on the prices of the resale houses go up as well. So It's just an amazing, interesting way to look at the market and an amazingly interesting time in the market. And the experts say that the housing shortage will be with us until 2032. And they estimate we are anywhere between 1.5 and 8 million homes short. So my recommendation to you as an investor is be part of the solution. Be part of the group that is supplying housing to people. It's the most historically proven asset class in the entire world. It's the most tax-favored asset class in America because the government needs you to help solve this problem. They need you to provide the housing. So do what they want. It's good advice. They're going to reward you for it, okay? The most tax-favored asset class in America. Anyway, we will have a new Wednesday Masterclass coming up. We do these every month. Our last one was on investing in notes, and I couldn't be there for that one, but I will be there for the next one. It's going to be great. So you can always check those out at jasonhartman.com/Wednesday and get on that list every single month and join us for our free masterclass. It's always the second Wednesday of every month. So we'll look forward to seeing you on the next episode, and happy investing.